Hi, let's try to answer the million-dollar question. Is Alibaba worth $1,000? If not, when would it reach it? Or would there be a possibility that Alibaba would never be able to attain that magical number? So before we begin, remember to help smash that like button and subscribe if you haven't already. Anyway, I know that this has been a long requested video and I apologize in the first place for having delayed this video for so long because I've been challenging my assumptions and was thinking how best to deliver this video. Anyway, in light of transparency, you can go back to my old videos. I think I have never deleted most of the videos, and you can see that I've updated my DCF model for Alibaba twice now, and this is the third time. So 2 videos ago, I actually updated or actually posted a DCF template guide 11 months ago. If I'm not wrong, it was in August of 2021, and updated since 5 months ago. So let's see what actually transpired around the last 15 months or so and challenge the different assumptions that we set in the first place. So I'm using a software called Capital IQ. You don't need to purchase the software or whatever. A lot of all these details are being furnished elsewhere, but I just use it because I have access to it and it's free of charge to me anyway. And just to provide you guys some of the projections, street consensus, and some of the expectations for Alibaba moving forward. So most of my numbers are extracted from this platform. Don't really hold me accountable for it. I'm following Wall Street as well. So that's that. So Alibaba has recently closed their financial year back in around May this year, and because the financial year is a little bit different and it's a little bit wonky, so the year ending is always on the 31st of March. So we will take reference from all the discussions then. So this is actually the first DCF template that I provided, I think 11 months back. And because, as you guys know, DCF is discounted cash flow. Essentially, I just took reference from the cash flow of the previous year and then just do a straight line projection outwards for 10 years. And these were the 3 cases that I came up for Alibaba around 11 months back. And we got an intrinsic value of around $320, which is quite high if you think about it again. Anyway, I think in my baseline or base case projection, we presume that the baseline cash flow actually do grow around 17.5%, 25%, or 12.5% from year 1 to year 5, and then we just pull down the growth rate. And evidently, after 2022, which is 1 year on, we realize that there is a huge disparity, and we'll be talking about it later on. So next up, I think 5 months back, I then continued building onto the model, and I even added an additional valuation metric, which is sum of the parts. So going back, looking at or comparing the assumptions that we did on our DCF again, evidently as time goes by and as you know more and as you uncover more of the businesses and you see the interim reports, it doesn't look good. That's why I started adjusting a lot of my growth rates downwards if you were to compare back then. So in the highs, I put 25%, which is quite optimistic looking back. And then now I adjusted down to 15%. And after crunching the numbers and looking through some of the interim updates, you then get a lowered price target of $261. And after the discount, it's at least around $220. And even now, in retrospect, $220 still seems quite expensive. And we will revisit why. So I then took an additional step forward and I broke up the different verticals of Alibaba, and I didn't even wanted to bother with Ant Financials, digital media, etc. I just looked at the 2 core businesses, core commerce and cloud computing. And I just slapped in I personally think that it's a pretty reasonable multiple, and I actually get around $170 to $210 range just valuing the business of the core commerce and cloud computing. And surprise, surprise, the market never fails to amaze people, and cheap can always get cheaper, discounts can always get discounted deeper. So from that perspective, if we were to look back into the street consensus for Alibaba back around 5 to 6 months ago, these were the street consensus for the growth rates of Alibaba. 2022, 20 to 23%, 2023, 17.85%, and 2024, 16.85%. So right now, if you were to go back and see the newly furnished projections and growth rates for Alibaba, in 2022, we actually did around 18 to 19. Let's put it 19%. So 19% in comparison to the 20 to 23, we did come down below expectations, even though it's not a huge miss, but still below. 17.85% if we were to compare, it suddenly went down to 8%. And of course, because of the dynamic situation, we know that China is developing in real time and people are getting new information day after day. So as the saying goes, when facts change, opinions must change. and which also means that street consensus changed, and of course your intrinsic value and a lot of these calculations of DCF, etc., gets brought down by many notches, as you can observe. And in 2024, the then projection was 16.85%, and now it's down to 13.49%. So if you were to look at it in totality, you can't really blame a lot of all these investment bankers or analysts and a lot of all these hedge funds, etc., that are constantly changing their opinions, because we are living in a very dynamic world. Things don't really just follow your expectations, and once you set it in stone, then the world must definitely deliver. No, we have to always be dynamic. And of course, this dynamism shouldn't be used as an excuse. But frankly speaking, a lot of all these projections that were done 5 months back, 10 months back, 15 months back, they're all under the water for now. So personally, I have updated a new valuation model for Alibaba and see what are the different expectations and assumptions moving forward. So let's take a look. I use specifically 2 valuations method. One is a EV/EBITDA approach, and the second one is a DCF method, which is the normal conventional way where everybody's talking about. So I think for the first part about using an EV/EBITDA method, it's slightly less accurate because sometimes numbers can be kind of massaged. And EBITDA is not really a very favored financial metric, especially for the grades of Munger and Buffett. They kind of hate EBITDA. But anyway, I think it's good to kind of supplement your entire valuation thesis, not just looking at a DCF. If you can use EV/EBITDA, sum of the parts, you want to use some other very fanciful strategies, it's fine with me as well. And I think one of the key important lessons that I've learned after doing a 2 updated DCF and being proved time and time again that I'm wrong, is that you can't even get your assumptions or expectations of a company 1 year right. Like we have experienced, a very big problem with a lot of our DCF is that our projections, even though we can argue that, hey, I think 12.5% year-on-year growth in terms of free cash flow is arguably conservative for Alibaba as a company, because hey, look, a lot of all their free cash flow growth for the last 5-6 years, it's at least 20, 30, 40% even. But then again, if you were to look at, I essentially went to screen grab one of Alibaba's presentation slides. You can see that in 2022, their free cash flow actually went down by negative 43%. So you can't even get 1 year right. Don't bother projecting out for 10 years. So this time around, I've learned my lesson, and I don't want to cry over spilled milk again. And essentially, we try to project out for 5 years instead. But I'll go one step further, saying that, hey, in the first year, because I essentially built this model out in the earlier part of this year, if I'm not wrong, and the numbers were not out yet. So essentially for the base, bear and bull case, it's all 19% because this is actually real hard figures that Alibaba has already delivered. So there's no qualms to it. So in terms of the projections for our base, bear and bull case, for the base case, I didn't put the numbers out of my ass. I essentially took Wall Street consensus or Wall Street analyst estimates, and you see that, hey, 8%, 13%, 11%. So I just essentially fill in the number here and try to be conservative by giving it a lower number if possible, and just flatline it to 10%. So this is my base case. I just followed whatever Capital IQ has, and this is probably an average growth rate of around 12%. Then similarly for bear case, 8%, then 10%, 10%, 10%. For my bull case, 13%, 15%, 15%, 15%. So let me try to walk you through my thought process. Over the last 2 years, China had a great deal of problems. I don't want to open a can of worms, but by saying that it's an easy time for tech firms over the last 2 years to continue delivering numbers, it's a tall order. And specifically speaking, we have a property bubble, we have an economy slowing down, we have perpetual lockdowns, we have a war going on, and given those backdrop, I think a lot of all these numbers are pretty depressed. Because if you have to look at Alibaba's growth rate for the last 7 years, it's hovering between 30 to 50%. And to say that they're gonna grow on an average of 11, 12% for the coming 4 years, sure, I know a lot of bears like to say that, they lost their story, they're not gonna come back anymore. GDP growth rate for China is gonna slow down from 5% down to 4, 3, 2, 1, and start going to a negative decline. I'm not gonna argue against that. You guys are definitely entitled to have your thoughts about that. But to be very honest, in my own projections, I think the bull case is actually my base case. But I can't fight Wall Street, so Wall Street consensus or estimates will be mine. And as you guys have already understood and seen, to be very honest, Wall Street estimates also just constantly moves and constantly changes. So I wouldn't even be surprised when China suddenly turns for the better and everybody starts getting excited again, and suddenly all the projections and expectations get shifted upwards. So that's that. So the second critical factor that we have to look into is the EBITDA margin. So based on, likewise, again, Wall Street consensus, they expect the EBITDA margin to kind of flat out back to 20%. But if we were to look at historical performance, margins are compressing, definitely. For whatever reason, I think for those of you who have been long-time Alibaba shareholders, you guys should know that they're trying to penetrate into adjacent markets, they're trying to expand their value proposition, and they're converting from a platform economy over to something that's more tangible, going to cloud, going into e-commerce, going to logistics, etc., etc. And all these are definitely compressing its margin. So if we were to look at long-term projections, even though in 2022, EBITDA margins definitely compressed to 15%, but analysts are expecting it to revert back to the normal or the median, which is around 20%. So I'll use 20% for my base case, 18% for my bear case, and 22% for my bull case. But keeping in mind, these are historical figures, and past performance don't represent future performances. So yeah, that's that. So the last important factor that we have to take into account would be the market multiple. So how do I actually derive 2016 and 24 long-term market multiple? Simply put, I just extracted the market multiples all the way back to 2015, and we are interested in this enterprise value to last 12-month EBITDA. And you can see back in 2015, a lot of all these numbers are in the 40s, or at least in the high 30s to 40s, all the way until probably 2020. And after 2020, when you have your good old and financial crackdown, whatever, then you can see that essentially the long-term multiple just crushed. Yeah, they just got crushed. And right now, on the 24th of May, it's trading at an 8 times EV/EBITDA multiple, and that's how crazy it is. Even though a lot of international investors like to believe that, the China risk cannot be quantified, you're investing in a communist regime, yada yada yada. Yeah, sure, 2015 China is not a communist. 2016, 2017, 2018, all these multiples are fake. Suits you. Whatever narrative and whatever story you guys want to drive, by all means, be my guest. So I think in terms of a long-term multiple, I think 4 years out, it's not really a very long time frame, but it's not very short as well. So I think reverting back to a normal multiple of 20 should be relatively conservative. And then we have a 16 multiple for the bear case and 24 multiple for the bull case. And we can see that based on the discussion here, I wouldn't say stock price at year 5. Like I said, the projection is for 4 years. So 2023, 2024, 25, 26. So in 2026, we are probably expecting a stock price of around $295 for the base case, $196 for the bear case, and $452 for the bull case. So, but like I suggest, I'm rather bullish for Alibaba as a company. Of course, my bull case is my base case, so I'm expecting a 2026 stock price to be probably around $300 to $450. That's closer to my expectations. But who knows? I've been wrong for at least 1 year now, so I wouldn't want to profuse saying that I'm an investing messiah. But if you were to really just look at it from a numbers perspective and this EV/EBITDA approach, you can see that even in the bear case, you're experiencing a CAGR of around 15% at a stock price of around 110, which is what it's trading, give or take now. And this sort of risk reward is only made available to you because there is so much depression in the stock price and the valuation, and how investors are essentially just all heading out to the door. I think I'll leave it up to you to decide into thinking whether this is a good risk reward perspective or not. And of course, diversify on your own personal risk level and your own personal risk tolerance, whatever you call it. Don't follow me and just go all in into Alibaba, because we have extremely different circumstances, and I don't wish to be liable for whatever you guys think that I should be liable for. Anyway, moving on to the second method, which is the DCF method. Like I said, I think this time around, this is considered a freak event for 2022. I was essentially unpleasantly surprised into Alibaba reporting such horrendous figures. But as you can see, I think in terms of the free cash flow growth, at least for the last 5 to 6 years, I do understand that, hey, there is some sort of discrepancy here. If you were to just use the method of cash from operations minus capex, the free cash flow is around 190, while CapIQ did spit back around 189, but based on Alibaba's own reporting, they actually reported 172. But that's besides the point. I think it's some technicalities that in terms of calculations and in terms of computations. So if you were to look at just percentage growth wise, it shouldn't technically have a very big difference, but the average for the last 5 years is actually 33%. So then begs the question, what's going to happen to this freak event? Are we going to revert back to the mean, or is this going to be the downfall of Alibaba? I think a lot of all these valuation techniques and how you look at the assumptions and expectations, it's more of an art than a science. Or as an investor, if you're bullish about the company, you'll put in bullish assumptions. If you're bear of the company, you'll put in bearish assumptions. So like I said, for year one, it's actually this year. So I actually plugged in a negative 48% growth because I wanted to match the free cash flow number to 98,000. So here comes the tricky part. How are you going to project forward? I think based on my current projection, I'm being incredibly conservative. And I'll explain to you why. Why conservative? You might see that, hey, 35%, 30%, 15, 15, it's actually quite big numbers if you were to compare backwards. But if you were to look at it on an absolute level, 172, 172. This is based on the assumption that in 2024, they're going to make back the free cash flow that they did in 2021. And just based on this conservative assumption, and then I brought it down to 15%. Similarly, free cash flow multiple, if I were to go back to the multiples table, when I look at market cap to free cash flow, in the previous times, back in 2015, the ratios are crazy essentially. You have 70 times, 48 times, 21 times, 36 times, and then back to 40s, 50s again. And you see the similar trend. Again, in 2020, after the price collapse, you can see that multiples just contract to 29, 20, 18, 16, 15, 14. So that's essentially what we are facing as a group of investors right now. So pulling it back, reverting back to the mean of 20 for a free cash flow multiple perspective, I don't think it's expensive. In fact, if Alibaba continues posing results or expectations of at least growing 12 to 15% top line, I think 20 multiple is just incredibly cheap. But that's besides the point. So I just applied a discount rate of 15%. Some of you like to use weighted average cost of capital. I think that's the scholarly way of doing it. But 15% discount rate, it's really just to give me an additional margin of safety. And I do have an expected internal rate of return of 15%. So I'll just discount it by 15%. And of course, the expected share price of today is actually $156. And the current share price of 110 actually gives you a margin of safety of 30%. So then you might ask me, hey, what's the expected share price of 2026? Because that's what we are looking for. So in 2026, based on all this free cash flow profile, discounted back 15%, you actually get back a price of around $273. And this is kind of in line with our base case. But like I said, this is extremely conservative numbers, and it's like really my bear case, even though I have a bear case here. But no, I don't even believe in these numbers that I input here. But anyway, I might be biased because I'm already a shareholder. You guys should do your own due diligence. So like I alluded previously, I think in 4 years' time, in 2026, the price will probably be around this range of $300 to $450. And this free cash flow profile, I can't even believe it, but I guess this just goes to show that Alibaba is still undervalued today, even at today's prices. So leave in the comment section down below what do you think. Remember to help smash the like button while you're leaving as well. And to answer the $1 million question about will Alibaba reach that magical number of $1,000, I still think they do. If you give them maybe 10 years, 10 to 15 years, I still think that it might have a potential of being a 10-bagger. And my relative valuation for Alibaba the other time, where I argued in one of my previous videos, saying that, hey, even a 10x from here, where Alibaba reaches $1,000, I think its market cap is probably less than $3 trillion. And Apple reached $3 trillion last year. I don't want to pitch it against big tech of the US, but I just think that on a relative basis, it does seem a little bit incomprehensible for Alibaba to be trading at $200 billion market cap and Apple trading at $3 trillion and Apple being 10 times the size. But when you look at the free cash flow profile, the profits they drive, and all the different numbers and metrics that you use, Alibaba shouldn't be trading at this valuation. But I know the context of China, the fear, etc. Is it warranted? I'll leave it up to you to decide. With that, I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye.